Hello everyone, my name is Kamal Manocha. I represent PMS AIF World, taking the rhythm of our Friday webinars ahead. Today we have a very interesting webinar that we're doing for the first time with Care PMS. Over last 5 years, we have discovered and learned and across all the discussions that we have done with various types of PMSs, we have realized that boutique PMSs really add a lot of value to clients because they handhold investors' money, in good times really well by generating a lot of alpha, and especially also in bad times by maintaining low beta and hand-holding them really well. That is the, I would say, belief and faith with which we are wanting to ourselves learn about the Care PMS in this presentation today, where we have Mr. Amit Doshi, who is the founder and director today and is the head portfolio manager and managing two, I would say, portfolio management schemes at Care PMS. One is a mid and large and mid focused, and one is a mid and small cap bias, a multi-cap focused fund. We'll cover both of those shortly in this webinar. Before we kind of start this presentation, I would like to maybe talk a few slides about Care PMS to kind of give you some background about what has been the track record. So if I kind of give you few attributes, it's a PMS which has been started by a team of chartered accountants. Amit Doshi, who is one of the speakers, he's one of the founding team members. He's CA, CFA, and brings with him more than 2 decades of experience across both the PMSs. They are managing more than 800 crores of clients across domestic as well as NRI clients. They have more than 10 years of experience, which I already mentioned. Now let me show you, how they have been generating alpha and how they have been outperforming the respective benchmark. This slide is absolutely self-explanatory. It is about the first PMS, which is Care PMS Growth Plus Value, which is basically targeted towards the, not just top 100, but the entire universe of stocks, which is large, mid, small, micro. And the returns, throughout are in front of you. You can see, there has been a tremendous alpha that they have been generating. Showing you similarly the returns of the second PMS scheme that they have, which is focused on the top 200 companies. This has been recently started, and this is also doing really well. Finally, few of the, I would say, areas which make them different are that yes, this is the only business that they are into. They are only dealing in listed equities. It's a concentrated portfolio, and promoters are very high skin in the game. It's not a single man company, but a team-based approach. So these are some of the, I would say, introductory aspects about Care PMS. This presentation is not about Care PMS. Obviously, the outcome has to be a solution, and that is where we have a product eventually unfolding. But this discussion is more about learning and addressing a very core, I would say, area of question which many investors and clients have on their minds today, because over last many years, a lot of things have changed with regards to stock markets. Many investors and many fund managers believe that there are new age sectors, new age businesses, which are competing with, old age businesses. And hence there is this fundamental question, which this webinar is going to address, which is old age businesses, are they dying or are they worth investing? Welcome, Amit, to this webinar. You can take ahead from here onwards for your presentation, and then we'll take Q&A subsequently. Thank you. Over to you.
Yeah, thank you, Kamal, for the kind introduction. So yeah, like you mentioned, typically, in fact, I and Kamal were discussing, what topic to discuss, and one of the key point of discussion, and especially in last 1.5 to 2 years, whenever we speak to our clients or somebody who is probably interested in equity markets and all, everybody is more interested in the new age business or the futuristic business, whether it is renewable space, whether it is electric vehicle, whether it is typical the startups, the like Zomato and PB Fintech and companies like that. So more and more people are kind of interested in those kind of companies, and at the same time somehow the interest has probably moved away from typically old age businesses, and where people are kind of less interested. So the idea of this presentation is to show that there is an equal amount of opportunity to make money in this kind of businesses as well, while of course you have to allocate your portfolio where you should have some portion or some allocation towards the new age business as well. But at the same time, the old age businesses are not like it's better not ignored, and they are not dying, and they are definitely worth investing. And that's where probably we'll cover over the next few slides that we'll be discussing about on this presentation. And especially in a time where everybody kind of market is in the overvalued zone, so where to put funds, at the same time you want to play safe, so that's something this probably topic hopefully would be interesting to many of the viewers out here. So thank you everyone, and now we'll begin with the presentation. So the first slide, I'll just cover what are the contents that I'm going to cover. So first is we'll just understand old and new age business, so that both of myself and speaker and the audience are on the same page as to understanding of what kind of old and new age business would mean, what will make the old age business attractive, and what as an investor, as a trader, as a stock market investor, what are the triggers that one should look for in such kind of companies. And then probably the most interesting part of the presentation, which is the case studies. Well, we'll take few cases and how it has panned over a period of 2, 3, 4 years, and how the returns have been made or could be made. So I've included both type of case studies. So that's going to be the broad agenda that I'll be covering. First things first, disclaimer, as a portfolio manager, as an investor, the examples that will be covered in this presentation are obviously to be considered only for education purposes and should not be considered as a recommendation, because we as a individual investor, as well as our PMS clients, own these companies in our portfolio. So just a bit of a disclaimer about that. So we'll start with the first point about understanding old and new age. So first, let's begin with the new age business. Typically the characteristics of the new age business is, they are very extremely innovative. So the way things will begin, any idea, it's more about the new age thought is the innovation, and that would be a disrupting idea. That's what generally it is considered as. And the third point is the futuristic. So everything, people think that, okay, what will people behave, or how people will access to particular kind of product or services in future. So it's going to be a futuristic, and generally, usually it is tech based, and mostly of late what we have seen, is generally asset light. So they are usually either tech based or very, very asset light. So that's the kind of characteristic of new age business. And one of the buzzword that if I want to just add to the new age business would be the talk of the town. That's what people, as I said, whenever you go meet, those are the companies that are discussed. And some examples I'll take. I think few names I already spoke about: Paytm, PB Fintech, Zomato, Olectra, Gintech, Borosil Renewables. So these kind of companies or the businesses which are more futuristic in nature is what I was referring to as the new age business. Now moving to the old age business. So typically, these are the businesses that are running for ages 20, 30, 40 years. So there's nothing new that's about the business, because whatever was new probably has happened in the initial 5, 10 or 15 years. And so therefore there is nothing new in the business. The second is, either it can be characterized as either a slow or a low growth story. So typically these businesses have been in existence for years. So it's more, kind of not a very high growth, extremely 30, 40% or 50% or 100% growth that we speak about in the new age business. So that's not the growth is what old age business generally is characterized as. And commoditized because, broadly, as I said, there's nothing new. So it has been developed over a period of time. So it has become commoditized. There is nothing much new to be done. So everybody probably may fall in the same place. They are mostly capital intensive. Heavy plant and machinery, the land bank requirement, and that's why they've been probably taken for last 20, 30, 40 years, and that's how they've been able to survive. And the last and one of the key point, where people probably want to avoid this kind of businesses is uncertain future. So we don't know whether, after 5 years, whether this growth would sustain or not, or whether this business would remain or not. And the buzzword that I would probably want to assign to the old age business is boring. That's where typically how people generally behave when we talk about these businesses. Moving on, some examples like cement, textile, paper, auto ink, metal, power. These are the businesses which are considered to be as an examples of old age business. Now we'll just quickly run through the pros and cons. So the pros of old age business is a con of new age business. So if we'll see, there is an existing market which is obviously ready. The businesses are in existence since ages. So there is a ready demand for the product. Market is in existence, and there is an extremely strong history and track record which is available. And the third point is cash flow. So cash flows there is a consistent cash flow, or we typically call cash cow businesses in our terms. So that's something which is the pros of old age business, and that same I would say opposite of it is cons of new age business, where this business needs the market needs to be created. There is no history, no track record. Nobody knows how industry various cycles, what point in time what behavior would happen, and they are generally a cash burning business where you typically burn cash in the initial phase of the year. Coming to the pros of new age business, they are futuristic. As we spoke, there is a huge potential for growth, and that's why the typically 50-100% growth rate is what is targeted at, and they are asset light, tech based. And similarly, exactly the cons of old age businesses, innovation is missing, there is nothing commoditized, growth could be missing, could be low or slow growth, as I said, and they're asset heavy businesses in general. So that's the pros and cons of the old and new age business. Now, just citing a quote of Warren Buffett, the quote is, our buying preference run towards business that generate cash and not those who consume it. And this quote is absolutely apt in this presentation, and also somewhere relates to our philosophy or our thinking vis-a-vis the kind of companies that we are going to discuss today. And that's the quote probably I thought would be worth looking at it. Now, whether old or new, why do we invest? That's the first point. So the growth of capital, that's the key reason of investing in the any company. So whenever we have a capital, we want to make it ensure that capital grows, money works for us. But there is a two parts to it, which I feel is equally important. One is the growth, but longevity of growth. So the growth is fine, but whether the growth is sustainable and there has to be continuous growing business, that's how my money will multiply. At the same time, safety of capital. So capital is growing is fine, but I should be investing in space. There has to be safety as well. So these are the two criteria which I believe is extremely critical while deciding investment, whether it is old age business or new age business. And because investing is not a sprint, it's a marathon, and that's why I thought to bring this point. Now, coming to the point of second point, which is what makes our old age businesses attractive. So I think what we spoke about the pros, I'll just kind of shortly repeat, but except one point. One, as I spoke about ready market, it's a predictability because there is a history, cyclical. We know what type of situation arises when there is excess supply, excess demand. So there is a bit of predictability. There is an entry barrier nature, and that is one of the important part, because some of the industries that exist today, it is very difficult to kind of start today. The kind of land mag, the kind of plant and machinery, the kind of years that has been invested in. So that makes an entry barrier, and that becomes, according to me, one of the pros or one of the factors that makes it attractive, because it's very difficult somebody could enter at this level and kind of start the same activity which these industries were started 20-30 years back. And the fourth part is valuation, which again makes it this old age business attractive. And here I would want to quote none other than Mr. Rakesh Jhunjhunwala, and he says, what I buy is important, but at what price I buy is extremely important, and therefore this valuation point is equally important. That that's one of the key factors, which makes this attractive. Now, how do we, once you classify this company, so what are the identification of triggers that you would see in the old age business? So there are 4 triggers which we generally feel, can be used to track as to, they would allow you to kind of, those triggers would allow you to make interest in those companies. So one is the change of management or change of management's thought process. So the moment there is a shift in the management, there is a new person who's sitting on the chair, or the person or the next generation might come in the business, or there is a thought process which has changed, from a typical continuing the same way, there is a bit of a change of thought process. So that's first trigger point. Second is change in industry dynamics. The business that they operate, after whatever 20-30 years, there is a possibility that dynamics of industry has changed, maybe because of the new age business disrupting the line, or some other government regulation, or some other factor which has changed in the industry dynamics. Third is capital allocation. How the company, which is, we spoke about old age business generating good cash flows, so how they would kind of do a capital allocation, and where the money that they are generating is being utilized will be a watch out factor for. And the last is encashing the existing assets, because these companies, the old age companies, have typically huge either land bank or a distribution network, and how they capitalize or how they encash on the existing assets is something. So these are the 4 triggers which we believe, if one can keep a watch of in the old age business, they'll be able to identify a good trigger point for investment in the old age business. Now, the most interesting part probably will start, which is the case studies. So the way I am going to take up each case study is, I'll be covering 5 points in each of the case studies. The first will be covering about the industry, then the company, what changed, like we spoke about, what are the changes that one should look for, how the cash flow utilization happened in that company, and how the valuation and how the returns can be generated. So this is the manner in which I'm going to cover all the case studies. So with that, we'll move on to the first case study, and the textile sector, which is again typically considered to be a old age, or the businesses which is there. So if you look at the textile industry chart, if you see from 2010 to 2022 on your screens, the growth that you see is 8% CAGR over last 12-15 years. And in fact, that 8% CAGR is primarily because 2010 to 2019. If you move to 2019 to 2022, the growth is far slower. So this is again where what we said earlier is the slow or low growth businesses. So that's the move of the industry. Now moving to the company. So I'm taking the Arvind, which is one of the well-known, the old textile industry, Arvind Mills, which is one of commonly known as company, and will take the businesses. Now there are 2 parts to the business. One is the typically old textile business, and one is the technical textile business. The textile business is denim, woven garments, that businesses which has been there since years. And there is a technical textile business where they have this fire retardant, human protection garments, fabrics. There are composites which they manufacture for multiple use, like windmill fans, or this Vande Bharat trains, or this in the industrial purpose, there are belts, etc., where the fibers are used. So those technical textile fibers is what also Arvind makes. So these are the 2 parts of the business. So just to give an introduction. Now what changed in this business? So clearly the change which we saw was the focus on the AMD business. AMD business is Advanced Material Division, or the technical textile that we spoke about earlier. So this has 3 divisions, as I said: human protection, various material related to defense or healthcare or firefighting, and the composite part, which is the second basket, is something which is making a huge currently growth. And the third is industrial. So this segment of technical textile had a very good growth. The management decided to focus their growth on this division, and this provides a niche opportunity, therefore good amount of margin that can be generated in this business. So that's the change that happened, and we'll see how it changed on impact on the financials of the company. So if we'll see how the revenue mix has changed from last 5 to 6 years. 2018, 88-90% of the contribution of revenue was coming from textile. The AMD division, or the technical textile division, was contributing just 7% of it. Now, as we speak, FY23, and now, of course, FY24 numbers have also come in. But just as a pie chart, the AMD, or the technical textile division, has now contributing to 15% of the revenue, and the textile has reduced from 88 to 80%. And as we speak now in FY24, this number is further improved in favor of the technical textile. And at the below table, that is you can see on the screen. So if you'll see more continuously, the top line of the company is roughly 6,700 crore, and has just moved to 8,300, 8,400 crore, which means it has grown just at the rate of 4% CAGR. But at the same time, if you see the highlighted segment, the AMD division, or the technical textile, has moved from 480 crore to now almost 1250, or as we speak, it will be close to 1500 crore plus sales. So that which is growing at 21%. So that's something which is the growing portion, and that's where the management started to focus. Now with this change in revenue mix, how the EBITDA mix has also changed, that is also important to see. Same way, if you see the FY18, the first chart, the first pie chart, the EBITDA was negative for technical textile division, but as we speak, FY23, almost 19% EBITDA contribution is coming from the AMD division, and now it would have been crossed 20% as well. And again, looking at the numbers on the below table, the total EBITDA, which was around 670 crore, has moved to just 800 crore, which means just a 3% CAGR. But AMD, which was a negative minus 7 crore, has now moved to 165 crore, and that's growing at 26% of CAGR. So while the industry or the textile business is not growing at a very high or a growth, but there is a segment inside which is doing extremely well, and that's how this contribution in EBITDA as well as revenue has changed. Now moving to the cash flow utilization. So as I said, 3,100 crore plus is the cash that company generated, and they utilized smartly, in repaying the debt of around 1,300 crore. Other general corporate purpose was 1,000 crore, and 800 crore was capex. And as far as capex is concerned, also there is an interesting part is they reduced the capex intensity, because of course textile is a capital intensive business. But if you'll notice from last 5 years, the intensity of capex was significantly reduced, and whatever capex was done is primarily now towards the garmenting or the AMD segment, and not to the typical textile old business that the return ratios where they are poor. So that is something which can be seen in the chart and the pie chart, which is allocation of 600 crore of next 2 years, what their plans are. So the 40% of the capex, which out of the 600 crore, is going to be allocated to AMD. So which again indicates where the management is focusing on, which division they are focusing, and that's where the future growth is going to come from. Now, how do we value? So what important is that, okay, now we know that, there is a one part of the business, which is a technical textile, is growing at a significant number. And so how do you value that part of the segment? So for example, if let's say we were probably, a 3-quarter back where, Q1 results had been announced of Arvind Limited, and what you would, as an investor, you would see that, okay, this business, which is of 500 crore, has grown at 20% CAGR and has come close to 1,300 crore. EBITDA has grown at 26%. Return on capital employed is more than 25%. So what P that I should allocate to this kind of business? And over a profit of around 135 crore, which was expected for financial year 24, what should be the P? So even if I apply 25 multiple, which is well deserved, because the revenue, EBITDA, and the return ratios all are about 20-25%, and to fair P multiple that could be applied to this business could be 25. So on 135 crore of PAT, if I apply multiple of 25, then the market value comes at 3,300 crore plus. And at that point in time, Arvind market cap was 4,000 crore. So I was getting a textile business at just hardly 15% of the total market cap, and the technical textile business, which is what I valued about, was 85% attribution to that business. So which means that I'm getting textile business as a free. This is growing. So I think I'm in a very good basket in terms of valuation, and there is a small portion which is significantly growing, which will become a big part of overall contribution of the business. And if you'll notice, how the valuation also changed during this period. So historically, you will see 2019 or this business was trading in the range of 9 to 10 P multiple. Of course, you exclude those to 2021 because of COVID losses. But again, you notice the P multiple was in the range of 10 till 2023, July 2023. But post which this value re-rating started, because the segment which is growing started contributing significantly to the company, and that's where the PE ratio also changed. The market re-rated this company, and which can also be seen in the shareholding pattern. So if you'll see, December 22 to March 24, institution holding FI and DI put together was 11 and 9, which is around 20%, and which is now consistently rising to 15 and 15, which is around 30%. So the public, 39 has moved to 29, and institution kind of soak in all the interest, and that's where the you can also see the price reflection of around 120, 130 business. 130 price is now 325, and as we speak is around today probably around 360, 370 of market price. So that's how the return can be generated even in the old age business. This can be visible from these slides, and that was my first case study. Now moving on to the second case study, which is now paper sector. Paper sector is also considered to be an equal, so to say, a low growth sector, or dying business, where people feel that we are moving in the era of digitalization. So how the paper market is likely to grow. So just to give you a glimpse of the global paper industry, where India is the fastest growing major paper market in the world, which is approximately 7-8%. Of course, other China, Indonesia, US, UK are either not growing or degrowing. But India is something which is growing. And if you look at per capita consumption as well, India is far, far below. So as and where we move up the ladder, there is a high possibility of India consuming higher and higher paper. So that's the part of the industry. Now moving on to the company, so JK Paper, which is one of the leader in this segment, and I've taken that as an example. And again, to give you a brief of the business, so there are again two businesses. One is paper business and one is packaging business. Paper business is uncoated paper, coated paper, which typically we use in the office printers, etc. And the coated is something which is used in magazine or high-end wedding invitation cards, etc. Typically the coated paper. And on the packaging front, again the packaging board, which we all have seen in the FMCG or the pharma products, and the corrugated boxes, where all the Amazon and Flipkart of the world have started using this corrugated boxes. So that's something which is the second part of the business, so packaging part. So these are the two businesses of JK Paper. While we look at JK Paper as a paper company, but that also has a segment of packaging. Now moving on, when I just spoke about when people feel that paper is a dying industry, then if we just look at JK Paper numbers from last 5 to 6 years, and you will see that there is a continuous revenue growth of 15%, and not only in value terms, in volume terms also there is a significant growth, and the same follows through in the EBITDA as well as the profit numbers of the JK Paper, which can be seen from the table below the charts that you will notice. So while value as well as volume, there is a consistent growth of double digit 15-20% plus, and that is reflected even in the numbers of the company. So it will be tough to say whether paper is a dying industry or whether JK Paper is not growing, but still, just to prove the numbers. Now, if you'll see where the growth is coming from, now that's where I said we have to focus on where the growth or what changes is happening in the company. So again here, if you'll see FY18 in terms of the capacity, the majority, so to say, capacity was almost towards the paper segment, which is uncoated and coated paper put together. Approximately 80% of the capacity was in the paper segment, whereas the packaging was just a 20% of it. Now, as we are in FY24, ratio is exactly reversed, and now almost 70% is in packaging capacity and 30% is a paper capacity. So which can be seen even in the numbers below. So they did some acquisition, they set up new capacity. So both put together, there is a growth which is more on the packaging side of it, and that's where the growth is coming from. Now, how the sales volume changed. So that's about, first slide was about the capacity. Now moving on to the sales volume. So similarly, you will notice that almost 80% sales volume was of course paper, and now that has significantly shifted again in the same ratio towards the packaging board. So now almost 60%, 60% plus is towards the packaging board, and the balance is towards the paper segment. And people generally, when we discuss paper business, people say it's a commodity business. So I thought to put this chart, which is slightly more important in terms of, how the margin trajectory of JK Paper is. So you will not continuously, 27, 28, 20, 25, 30, and 24. So there is a consistently higher double digit, forget 20% plus margin, which company has been generating. And that 20% is again FY21, which was one of the worst year for the paper business, which is COVID, where schools, offices all were closed. So even in that year, they had a 20% EBITDA margins. So just to prove the point that whether it is really a commodity business, somebody needs to kind of check that part. And if you'll note, JK Paper has around 30% contribution from branded sales. So they have this JK Copier brand, which contributes almost 30% of their sales, and they are market leaders because their market share is almost 29-30%. So whether it can be kind of commodity, whether it can be said that they are into commodity business. I'm not sure. At least number does not say that, and it says that it's something else. So that's what for you to judge. Moving on to the third part, which we discussed about all companies, is cash flow. So how the cash flow is utilized. So over last 5 to 6 years, company generated almost 6,000 crore plus cash, and out of which 550 crore was paid as dividend. Almost 3,000 crore was done as capex. I spoke about there were capex which was done on the packaging side, and that's where the growth is coming from. And parallelly, they also did some acquisitions again on the packaging side, one on the paper and 3 on the packaging side, which you can see on the table, where they acquired some companies in the packaging segment, and that's how. So the kind of cash flow of 6,400 crore that they generated, almost 50% plus 60% it was done towards the growth of packaging business, either by acquiring or by doing a capex on their own. Again, now moving to returns and ratio, because typically if you see, if you take profit growth of last 3 years, 5 years, or 10 years, and same way if you see the return on equity ratios of last 3 years, 5 years, or 10 years, all are in higher double digits of 18-20% plus in terms of return on equity, and profit growth is almost 30% plus. And people say that in commodity, typically you have to enter at the right time and exit at the right time, otherwise you will not have a good return generation. But if you see the middle chart of stock price CAGR, whether you take 10-year, 5-year, or 3-year, the 20% plus return has been generated. And if the below charts, 2 charts are also showing the same thing. So 5-year return is almost 2.5x and 10-year return is almost 10x. So irrespective of what price point probably you entered, you have made decent amount of money in 3, 5, or 10-year period horizon. So just again to back the point of the old age business, while paper we think, but growth is coming on the packaging, and equal amount of return can be generated. Having said that, going to the valuation chart of P ratio, of course, again it is very weird because of the initial losses. But if you see historically, it's in the range of 5 to 10, or sometimes 12, 14 multiple. So band of 5 to 14. And currently, as we speak, it is one of the at the lowest quoting at the lowest P multiple, which is close to 5 and 6. And I think it definitely deserves a better P multiple with more tilt towards packaging, more revenue and profitability coming from the packaging side. And since that packaging business, which is growing in double digit, while paper business growing in the single digit, but packaging business which is growing in double digit, that this company definitely deserves a double digit P multiple, and that's where probably the future returns are likely to come from. So that's something for you to watch out in this company. Now moving on to the third sector, third case study. I'll take the music business, because the way we have consumed business, music has significantly changed post-COVID, and that's why. So one of the changes that we discussed earlier about the change of industry dynamics, the trigger. So this case study would perfectly fit in that. The way we consume music and content or media consumption, has significantly shifted from while TV has remained from 5 hours to almost 4.5 hours, but the mobile consumption of 45 minutes has gone to 4 hour plus. So this is last 10-year, 11-year trajectory of, and this is a global media consumption story. So that's how we have the way it has changed. And if you see the music industry in particular, then the way the pink bar, which indicates the physical consumption, which is the CD, the cassette, etc., has clearly reduced, and the streaming, which is the turquoise blue color, which you can see has moved up from 0 to today almost $17 billion. So that's how this shift in the industry has happened because of the streaming business and the way we consume media. And the company that I'm going to discuss is Saregama. So this is again a broad overview of the business, where they were always into the songs, which is have the largest library of more than 150,000 songs. The key change that happened is around in the range of 2016-2017, where the new MD came, and they started encashing the existing assets, which is the music, through the launch of Carva. They started investing in the non-film music. They got into the movie production, where OTT, the the Netflix of the world had started producing contents, and that's where they started in the movie production, and they are now also into the live event business. So from the music business, how they have changed their focus is something which can be seen from this chart. And if you look at Indian music industry also, post COVID, the music industry also significantly changed. So if you look from 2020 or 2021 onwards, then from a 1500 crore average music industry significantly jumped to 2800 crore, and now expected in 2 years of almost 3700 to 4000 crore of music industry. And same way in Saregama, the music licensing growth also jumped in from 2020 onwards, from rough 150 to 200 crores range straight away, jumping now to 550 crores, and it would be expected to be around 800 crore plus in next 2 years. So one of the reason, while of course how the way we changed also changed, but piracy was one of the key reason for jump in this. So there is a change in industry dynamics as well. And these are the music partners through which they earn revenue. And if you'll see what change I spoke about, the music which was 90% of the revenue is now shifted to more than, reduced to 60%, 75%, and expected to reduce to 60%. And this music business, or the content business, or the production, TV and film, and the event business is now close to 25% and expected to go up to 40%. So that's where the change is happening. And same way you can see even in the financials, the numbers also trajectory significantly changed, and even in the profitability of the company can be seen. Again, cash flow utilization, 400 crore moved to 152. They used the 400 crore, the regular cash, towards music acquisition of, annually 150 to 200 crore. They pay dividend. They have also raised money in between of around 400 crore, which, around 700 crore, and out of which they have invested around 200 crore for one of the acquisition of the short film movie content production house, and balance amount of 550 crore they have kept themselves for in the arm chest for buying more inorganic acquisition. So that indicates how the company's cash flow are going to be utilized. And the stock price since last almost 2.5 years has been in the same range, and we believe going forward it has a good scope to generate returns. With that, I'll come to my last case study, print media, and which is again, newspaper business is considered to be a dying business, and that also kind of confirms from this chart where pre-COVID growth is not yet kind of kicked in, and the sector revenue also are flattish since quite some time. And how the ad industry, because for the paper, of course, first revenue is circulation revenue, but second revenue is the ad revenue, the biggest chunk. The significant shift has happened from print, which was in 2011, 10, 12 years back, it consumed 46% of the ad pie chart, is now shifted to just 16% of it. So that's clearly, one of the indicators. But what is changing in this company, and which I will talk about, is the company is DB Corp, the Dainik Bhaskar or the Divya Bhaskar newspaper, which you might have seen. And they also own a radio channel, and they also have a digital app, which can be seen on the last line of the slide. So what changed? Now coming to, like in 2019, so I've put a table of, various appointments that happened in the company, and I've put the whole chart, especially to see the, the kind of company's focus. So they appointed last two names, if you will see, they have appointed in 2019, well before COVID. So management realized that, we have to kind of shift our focus towards the digital side of it, and the kind of pay hikes, the pay that they almost 20 crore put together, two guys they have appointed, that shows the focus of the management in the digital segment. And if you'll see, they started building up the app, and if you'll see the DB Corp app, had just 2 million monthly active users, have now jumped to 12 million active users. And if you'll see all other news channel, all other news, print media news, mobile application, the numbers are very low. So this indicates the kind of digital engagement which company has entered into. And what makes us believe that this digital will be the future success is the reasons are clearly they have a regional language focus. They are not into English. They are either Hindi or Gujarati or Marathi. They are providing the local news, and which is ad free in the application, the digital app. there is a significant scope of monetization because 33% of the users are international and 30% of the users are searching for location. I mean, for example, somebody who is in Mumbai, but he's looking for the news in his hometown, either in the UP or Gujarat, and those are the people who are actually the genuine users. So there is a significant scope for monetization there, which they have not even started. And the appointment of the New York Times ex-CEO in FY22, and under whom the NYT, the New York Times itself, has grown from 36% digital subscription to almost 90% subscription. So that's the guy who is now kind of on the board of the company, and that indicates the focus of the company on the digital side. And again, the cash flow utilization, company has invested around 300 crore in digital, and balance amount of 600 crore is still lying as investment, with 500 crore paid out as a dividend to the shareholders. So in future, circulation revenue currently is around 25%, ad revenue is around 75%, but digital is currently almost zero. So what is going to be in future? That's a question mark. And from the reason I spoke about, I feel there is a strong scope of growth in the digital side, and that can probably re-rate the company from where it is. So currently, of course, there is after post-COVID, the newspaper circulation has come back to the old level. So now the stock price also indicates on the similar line. But going forward, the digital hopefully should contribute and should drive the valuation of this company. So with this, I kind of wrap my presentation. The key takeaways, if I just want to shortly repeat, we cannot write off the old age business just on the face of it. We really need to watch out for the right triggers to identify those old businesses and where there is a immense opportunity to make money. And more importantly, growing capital with safety. So while when we look at new age business or any businesses where we invest at a very high P multiple, 30, 40, 50 or 100 multiple, so the safety part is slightly lower. As a fund manager, as a portfolio manager, we believe that when we are managing somebody else's money, safety of capital is also equally important, and therefore growing capital with safety, this is something which gives a clear comfort on the safety side of as well. While the growth clearly there are triggers to grow, and as a portfolio you can always balance. So like we have named our strategy also growth plus value. So there is a value part of it, there is a growth part of it. So there is a right balance, and you can also do a old age, new age allocation in the portfolio where you can generate enough returns with decent safety. So and just will probably end the presentation with a quote of George Soros, when he says that good investment is boring, and if you are making fun, then probably you may not be making money. You need to kind of check the numbers that your bank statement gives. So that's the wrap of this presentation, and with that I'll just without fail thank the Care PMS team who has helped me in putting up this presentation, the PMS AIF team giving this platform, and all others, as you can see on the screen, the website or the data points where we source our data from, all the websites. I would like to give credit to all the other websites as well. And with that, that's a thanks from my side.
Thanks, Amit. I think this was a very interesting presentation. A very different thought. So, this brings a lot of questions to my mind. Foremost is that, for next 3 years, amongst the two segments that you have kind of given a balanced view, where would you have, more, I would say, allocations?
No, I will. So I think one of the key part which I probably at this point in time I would look for is the valuation. So if valuation is not in my comfort zone, probably I would tilt my portfolio slightly towards the kind of more safety ways which I just spoke about. But yeah, I will be managing a balance. But yeah, definitely tilt will be towards the safety side, and therefore towards where valuations are more in my favor, and there are enough triggers which I spoke about, which will happen or which will pan out in next 2 years, which will give me the enough returns that I am looking for as a portfolio manager. So something what happened in Arvind 2 years back can happen in the other two companies which I spoke about. So yeah.
Sure. So, whatever is the outcome of the upcoming central government elections, will that also make a change in your, I would say, convictions? As of now, you're trying to keep a balance, but have you kept, a plan A, plan B, keeping in mind, what will be the outcome?
No, so I think as a portfolio manager, while of course macro events are definitely kept at the back of the mind while making the decision, but when we typically do so we follow this bottom-up approach where you select a particular company. So there could be a bit of a ups and downs in terms of the outcomes of these macro events that would keep on happening, but our company, if the steps are being taken in the right direction, and unless there is a change in the government policy of the businesses where I am invested in, so if these two things remain the same, I don't think my approach will change vis-a-vis whatever be the election outcomes. In fact, if that gives me any more opportunity, I would be buying more of it. But yeah, coming back to your original question in terms of changing the thought process depending on the allocation, or whether plan A or plan B, no. But yeah, something where we have gone invested on the basis of, say, government policy. Say for example, we invested in the PSUs, or we have invested in the mining companies in last 1.5 year, or where we invested in the say segment related to railways, where government focus is, and if government changes or the government thought process changes, then definitely it needs a relook. But without that, I don't think that needs a relook. And process is more of a fundamental, which is over a period of 2 to 3 years.
Sure. So you mentioned that you follow more of a bottoms-up approach where your focus is, more on the business in terms of its valuations and growth potential. At the same time, I see that the portfolio is quite differentiated. So I'm sure there is some lens which may be, beyond bottoms-up approach, which could be special situations, or which could be, ideation at a thematic level in terms of, what's the leading sector which is going to be upcoming. So how does it actually work? Because it cannot be purely bottoms up. How would you ultimately, how do all these differentiated names come into your portfolios?
No, so yeah, so differentiated names definitely come in, but yeah, there is definitely a thought process about thematic. So, like I spoke about the railway sector or the PSUs. So we definitely saw the change in the government's thought process about, say, for example, take the case of mining business. Okay, we invested about a year back in the GMDC. So, what was the thought process? The change, the government kept on speaking about the rare earth minerals. Government made some appointments on the boards of some companies of the PSUs. Government allocated some cash, and they told to use the to kind of become more aggressive in terms of capex. If you'll note, in Coal India recently, 35,000 crore capex is what the company is planning for, which they have not planned in last many years. So this shows the change in the thought process. So now, of course, when you keep on reading in the markets, or you are constantly studying, going through the quarterly results, the con calls, the management commentary, you get the sense of where the thought process is changing. So particularly as I spoke about the mining, we definitely sense the change of focus on the government's idea of going on the self atmanirbharta on the rare earth metals. And logically, government would not allow all the private companies to go into that business. So the PSU was the focus, and where that could happen, and we saw some changes in particular companies' board, and then we thought, oh, this is something which can really click in. So that probably one. Second, I would say railway. Government has been extremely vocal about their investments in the railway infrastructure space, and that's again. So from that thinking, you filter a lot of companies. You go through quarterly results, the management capex, the capacity that management has already access to, the management, they have already been proven in the past. So that can be easily betted upon. So railway was another example. Power sector, if I want to say. So when I'm talking about this thematic segment, then in thematic, probably these companies, this sector were the first to kind of from the top down approach we figured out, and then we filtered out the companies in that basket, and then we invested in the power sector, the mining sector, the railway sector. And yes, so definitely bottom up as well as thematic. So it's a mix of both. There is not particular approach, but yeah, more of bottom up. So but yeah, there are these thematic investments that definitely happens as a part of the portfolio management.
So what is the role of three member investment committee? How are your three other two co-founders roles assigned, and how do you kind of add value to each other in overall context?
See, what typically happens, all are individuals, and there are always personal biases. So when instead of individual, when there is a team, there is always a perspective of a alternate guy, from a different perspective. And that what we have noticed in last 14 years that adds a significant, allows to move away from the self biases, personal biases that a person has. So, for example, I am particularly for any particular company, I am a very biased. Let's say case of a JK paper, where my partner may not be that much biased towards that. So he would always try to bring out those negatives or the other side of the story, and that would kind of allow us to make more informed, more allowing moving away from those personal biases and making those investment choices and allocating weight accordingly. So we might not go overboard on a particular company with reference to those personal biases. And of course there is a strategy in place. So we, as a Care PMS also, we don't invest in any particular company more than 12% of the portfolio. So there are the sector caps, the company's caps that we also have, but primarily this definitely helps in adding to the perspective and avoiding this personal bias, is what I believe helps in the when you have a more than one person as a investment decision making.
Sure. So we are seeing a lot of companies are coming to the stock market, through IPO route, and that process is like catching up, because more than 10 crore demat accounts have been opened, and many. So do you see, that is this a good way to make money, or is it a value trap? From the point of view of your conviction towards new age businesses, because many new age businesses are coming through IPO market to the stock market.
Yeah. So I honestly, I mean, this is a very good route of, a platform, so to say, to kind of participate in multiple companies and these new age stories as an investor. But at the end of the day, we are here to make money. So if valuation is not in my favor, I think I would want to give it a skip. So multiple companies which came as a IPO, what typically happens in this new age, because these are the talk of the town, and they probably foresee or kind of price in the next 3-year, 5-year revenue and profitability. So that's where our comfort slightly reduces. We believe that you can give at most 1 to 2 year of a sales growth or a profit growth. You can't go to 5-year. Next 5 year this company is going to generate this kind of profit, this kind of sales, and therefore today I will pay that price for it. So that's something which is not in our comfort zone. And so companies where valuations are definitely in our comfort zone will don't mind buying it. But yeah, as a platform, as an IPO platform, is a very nice route to kind of allow a retail investor to participate in. But I think as a investor, I think I would be more wary of the valuation that they typically offer, especially in the IPO market, where the lot of liquidity is chasing limited number of IPOs, and typically those IPO gains are tracked for. So that's where my resistance.
My question was more pertaining to the fact that there could be many promoters who have been working for many years, many decades, and now when equity markets are kind of at all-time highs, there's a lot of demand for IPOs. There will be many such promoters who may find this as an opportunity to unlock a lot of hard work that they have done, and then once they have done that unlocking activity, they may after that become complacent for some years. So getting into those companies now at higher valuations when markets are also high, maybe is a trap. So how will you kind of prevent yourself as a fund manager from that?
So staying away from those companies is the best way. Keeping in track, keeping the quarterly numbers in target. So what they said versus what they deliver is something that one should clearly watch out for. I mean, multiple cases. There are so many examples in the last 1.5, 2 years, whether you take Zomato, multiple examples that I don't want to name any particular company, Sirma SGS recently, the kind of stories that were built in at the time of IPO and post IPO quarterly numbers. But if you will see from last 2-3 quarters, the numbers are just flattish. So, those 30%, 40% growth, which had been spoken about, they don't always translate. So the kind of journey which everybody feels is going to be the smooth may not be that exactly the smooth. So yes, so I think the step one would be whenever there is an overvaluation zone, you stay away from those companies, but definitely keep in watch list, because some of the businesses that they come in are really good. I mean, they like you said, there's a lot of number of years of hard work that they have built in, and they have cracked the kind of clients that they are currently catering to. It's remarkably achievable. And so yes, you keep in the watch list, you watch out for what they say and what they deliver, and if they're delivering well and if valuations are in your comfort, you put your money. But if it's not in comfort, it's okay even if you miss some of the opportunities. There is a famous saying of I just forget the name, but you can't kiss all the girls, all the beautiful girls in the market. So it's like that. You miss some opportunities, but not at the cost of safety of my capital.
Sure. So, you have mentioned about balancing between old economy businesses and new economy businesses. And I understand, old economy businesses could be seen with the lens of valuation, and new economy businesses could be seen with the lens of maybe growth, right? So if you have, obviously as a fund manager, I have mostly come across those fund managers who have a bias towards one area, and who will be focused towards growth, and they will say we will ignore valuation, but we give more focus to growth.
Right.
Others will say, valuations is most important. Growth is something that we'll be kind of, having a common sense that will come. And that's what is the foresight all about. But you're talking about balance. That is what is kind of, giving me this question that if you have to select between two, how will you select a decently valued old economy company or a, decently expensive, focused new age business?
So that's why I said, no, so we have actually both type of businesses in our portfolio. So currently, of course, the case study that I spoke about were primarily, the old age businesses, but we definitely have the new age businesses as well in our portfolio. But the allocation, as I said, is slightly lower at this point in time, considering the valuation. And we will definitely would want to build in more if the valuations comes in our favor. So say, for example, like renewable and electric vehicles and chargers, Tata Power. So that had been one of the, significant allocation in our portfolio. So there is definitely an allocation. So it is maintaining that balance. So as I said in the initial first question also, the tilt is slightly more towards at this point in time, as we speak, is towards the more focus on the valuation than on the growth, because not all growth can be sustainable at the same rate. Unless it really is, and we look for this PE growth, PEG multiple, where if the company is growing at 30%, I don't mind giving the 30 or 40 PE multiple, but at the same time, if the company is growing at say 10, 15, 20 multiple, I'll not be comfortable giving 40, 50 multiple, just because in future this company is likely to do extremely well, because this solar, the renewable space, there is a lot of hue and cry about these companies are going to be future and they will deliver in next 3 years, 5 years. They have order book of 1,000 crores of this and that. So that's something where, as I said, our resistance likely builds in. So we are not comfortable giving a multiple of revenue or profitability or 3, 4, 5 years. Till 2 years, we are comfortable, and if it fits within that PEG multiple, then we'd be okay to buy. And so that's how probably the balance can be maintained as a portfolio manager.
Sure. So, I also belong to family of chartered accountants, and whenever we sit over drinks or dinner, we discuss some of these new age companies where valuations are very obnoxious. I've seen most chartered accountants are focused on valuations more. They are more focused on either trying to find out special situations oriented value investing or pure value investing. They will always have a view that markets are expensive, and new age businesses are like something which are way to ultimately destroy your wealth. Now, as a chartered accountant turned fund manager, how do you garner courage to enter into all these new age companies which have infinite valuations?
So I think so. This is again clearly a change of perspective. See, when you okay, I mean, like when you say that probably all chartered accountants are focused more on valuation, I think that may not be true, because again here the approach of the person will significantly differ because of the again. So like I'm coming back to my old points of bottom up approach. So while at the index level, or you talk about that Nifty is at all-time high, or the Sensex is at all-time high. These IPOs are coming at 50 and 100 PE multiple. That is one part of it. But there is always pockets of business opportunities which are there, and there is enough money to be made. So when you look at the bottom-up approach, the PE multiple or the PEG multiple will be definitely in the comfortable zone, and you don't mind putting in money. As I said, again, you look at those typical. So we are pure fundamental investors, right? So we don't look at charts or technicals of the technical side of it. We focus on more of fundamentals. So where there is a good balance sheet, more comfortable balance sheet, and the growth is there. It's not that old age businesses, or forget old or new. Any company where there is a growth of 20%, 25%, 15%, and if it is available at 15, 20, 30 per P multiple, we are extremely okay to buy those companies. So I think when you say all the CAs are more valuation, because I would say value investors are definitely more focused towards value in valuation, and they are more interested in investing in the cheap P multiple stocks, where typically those companies don't trade at 20, 30, 40, 50 P multiple, but they are in the range of 5 to 15 multiple, so to say. But that is a concept of value investing, is what I would say. But as a portfolio manager, we are as I said, growth and value put together. So there is a mix of both, and I think there are enough opportunities. See, there are more than 5,000 companies available, and now more and more companies getting added in the stock market every day. So there are enough opportunities in the market, and you don't need to be definitely being invested upon in the every talk of the town. So probably 2-3 years back in the post-COVID, there was a after 2018, there was a long-term capital gain tax when it was introduced. Post which there was a significant erosion in the small and mid-cap basket, and where people felt only the quality stocks will do well. Well, if you'll see last 3 to 3.5 years, I think that has not turned out to be true. So I think there is always a cycle as well, which one needs to be mindful about. And valuation again plays a significant role. So again, doing a balance of both is what makes it a good manager, a portfolio manager, or an investor where you make decent money for yourself.
Sure, Amit. I think it's really pleasure meeting with you, and the quote behind you, which I think says "Laugh every day, love beyond."
Yeah. So it's a live, laugh, and love. So live every moment, laugh every day, and love beyond words. So yeah, that's the quote that I love. So I've kept as a part of my cabin.
Sure, I think you have a lot of passion around you, and keep that passion going. From the point of view of returns, and continue to keep generating alpha. Good luck to you. It was a pleasure connecting with you. Thank you everyone for joining with us today on this Friday webinar. Thank you everyone.
Thank you, Kamal.
Pleasure.